could start the recording, that would be great. My name's Charlotte Fidipi. I'm the Chief Communications Officer here at the CEA, and I just want to welcome everybody to yet another one of our engagement sessions with our stakeholders. We look forward to having these all the time. We've had about 3 or 4 this year, and we've got a couple more slated. So we're just really hopeful that you will take part and share your views and comments with us as we discuss some really important strategic issues that we are grappling with here at the CEA. A couple of announcements, and these are probably very familiar to you guys right now, but I do want to repeat them because it does bears remembering. We're on Zoom, obviously, and anything can go wrong technically. So if you could take a note of this number, 916-399-3895, maybe take a screenshot of it or write it down. That can help you if we get into any technical difficulties. We've got Swan standing by, and he'll be happy to help. We have Spanish and American Sign Language interpretation and translations going on. So as you know, at the bottom of your Zoom control bar, there are little buttons there that you can press so that what we are saying is translated into a language that you may be more comfortable with. And I want to say thank you to Marlene and Angela, Yelka, and Giovanna for helping us with these translations. We also have closed captioning that's available again using your Zoom control bar. If you've got any questions during this session, we want you to ideally just raise your hand. We want this to be informal. We want to hear your points of view. So ideally raise your hand, or you can use the Q&A feature. If you're joining us by Zoom, press *9 and then we will call on you. If for any reason we don't get to address your concerns during this meeting, please feel free to email us at calquakefeedback@calquake.com. That's calquakefeedback@calquake.com. And as I say, we will try and address your concerns during the meeting, but that's a useful address if you need to contact us otherwise. We are recording this meeting for future use. We may make it available on social media and on our website. By you staying online, that is your consent to our recording. We have allowed about 90 minutes or so for this meeting, but we can be flexible with time. We've got 3 or 4 topics that we want to chat to you guys about. And so I hope you all had a look at the meeting deck and the materials we posted online. Okay, that's my sort of housekeeping, as it were. I'm going to turn it over to Joe Zuber, because he will take us through our antitrust statement. Joe?
Thank you, Charlotte. There we go. My video didn't want to start, but now it did. So, as Charlotte indicated, this is the antitrust statement. This is a meeting organized by the California Earthquake Authority, which we usually refer to as the CEA. It's possible that representatives of insurance companies, perhaps including those of CEA participating insurers and possibly those of non-participating insurers, might be in attendance. So whenever there are meetings organized or attended by representatives of multiple insurance companies during which the business of insurance is discussed, including CEA operations and policy, it's important for participants to keep antitrust policies in mind and to abide by these policies. For that reason, when participating in this meeting, please keep these following guidelines in mind. First, an employee or representative of an insurance company must not discuss that company's insurance business, including in the case with CEA participating insurer, how that company conducts its CEA business. An insurance company employees and representatives must not discuss the business of either a CEA participating insurer or a non-participating insurer. And then finally, in the case with CEA participating insurer, we'd ask that you do not discuss at this meeting how that participating insurer handles or services its CEA policies. Any discussion of that topic should be in a separate meeting or conversation solely between that insurer and the CEA. Also, I want to mention that it's the individual responsibility of each of us in this meeting to ask the discussion be stopped if it should stray outside these guidelines. And that's the fascinating part, Charlotte. So back to you and or Tom.
Thanks, Joe. Before I hand it over to Tom, I just want to remind everybody that as much as possible, we would love you to put your cameras on so we can see who we're talking to. But if you don't feel comfortable, that's okay as well. But when you are not on camera, if you wouldn't mind just making sure that your microphone is muted, that will help with all the audio issues. And with that, I'll hand it over to Tom Welsh, who is our interim CEO. Tom, take it away.
Thank you, Charlotte, and thanks, Joe, for the antitrust admonition. I don't want that to chill people's enthusiasm for sharing thoughts about CEA and our objectives. Just as a reminder, for those of you who haven't met me, I'm Tom Welsh. I'm the acting or interim CEO at the CEA. I'm also the Chief Legal and Compliance Officer. And for those of you who are tracking, our board's process of filling permanently the CEO position, that process is ongoing. The search has been ongoing since the beginning of the year. It should culminate in June, at the latest, early July. So I'm a candidate. There are a couple of there's a number of outside candidates, and the board will be doing interviews and picking, I'm sure, a good solid leadership for the CEA moving forward. The reason I mention that is because during this interim period of time, we're really focused on a couple of things. One, maintaining operational stability and operational excellence within the CEA, including our event readiness, ensuring that we, during this transition period, are ready to respond to an event should something happen between now and when a permanent CEO comes on board. And we're also engaging in this stakeholder outreach process to gather a bunch of information to set up the new CEO to partner with our board in the second half of the year to formulate a 5-year or multi-year strategic plan that aligns with the interests of stakeholders and balances all of our stakeholders' interests in the CEA's long-term success, stability, and sustainability. So our goals here, as I mentioned during the first formation meeting, or the organizational meeting that we had on February 22nd, the goals here are to create a channel, but not the exclusive channel, of providing feedback to the CEA. We really want a collaborative, mutually respectful exchange of ideas here, but also, if any of you want to share thoughts and opinions individually with us, please reach out. We're going to make time to receive that and spend time with you to make sure we understand your thoughts and feedback, and really continue to build on a relationship of trust with all of our stakeholders, so that we gather up information that will be helpful to the board and the CEO in formulating that multi-year plan. We decided to organize these substantive sessions around some of the key objectives, polarities, goals that we have in operating the company that require quite a bit of balancing. And we realized that, as we look at these, sometimes we call them competing objectives, but as we look at these drivers of our business, we didn't want to try to put them all on the table all at once. So we broke them into 2 chunks for the first couple of sessions. Last session in April, we really honed in on the blue bubbles, financial strength and rate stability, and the potential trade-offs and management of those, the pros and cons of those elements. And today, we have a series of policy questions to prompt discussion around product structure, CEA's post-event sustainability, our ability to, even after a really big, potentially capital impairing earthquake, our ability to continue to offer new and renewal policies to customers who want protection against the peril of earthquake. And then growth, the implications of growing our policies in force, and also growth and as you'll see on some of the prompts, the relationship between CEA and the rest of the companies that are offering one form or another of earthquake insurance. So the focus is on those 3. And then when we get to the end of the meeting, we have one last slide that kind of lays out and introduces what we will do in another session on, I think it's August 1st is the date that we've targeted for a session where we'll put a lot of these things back on the table, and we'll have a more holistic discussion about how we manage, or how you as stakeholders suggest that the board and the leadership team here manage through those competing objectives. So without further ado, let's jump to the next slide and focus in on product structure. And for this one, our Chief Insurance and Claims Officer, George Sittner, who joined us last year, is going to lead off the discussion of that, talk a little bit about what's on the next slide, which is some background. And as you probably noticed through this slide deck, we'll provide a little bit of background, sort of context for the discussion, and then dive into some questions and ask for your feedback. So without further ado, George, thank you.
Thanks, Tom. Appreciate that introduction. And good morning, everyone. Thanks for joining. As Tom explained, we'll talk about the background. We have some questions we want to ask you surrounding our product and coverage and its structure. Those are on the next slide. But prior to asking those questions, we'll go through what our product looks like by coverage and by limit. The column on the left shows the coverage type. The center column shows the minimum limit required by state law. That's the statutory minimums, not just for the CEA, but for any carrier that wants to sell earthquake insurance in California. And the column on the right are the options provided by the CEA. Coverage A dwelling as your coverage A limit is replacement cost. That replacement cost is determined by the participating insurer that provides the policy to our policyholder. It's replacement cost coverage. Many home policies offer replacement cost coverage, but claims are settled at an actual cash value basis. And then when the repairs are done, the insurer pays the difference between the actual cash value and replacement cost. The CEA policy, however, settles all claims at replacement costs subject to terms and conditions of the policy. Coverage C, personal property, that's the contents of your home. $5,000 is the state minimum. The CEA offers $5,000 and $25,000 limits. Coverage G, ALE or additional living expense. Should you not be able to live in your home because of damage from an earthquake, state minimum is $1,500. The CEA offers several different increments up to $100,000. Mitigation discount. The minimum required by state law for the CEA is 5%, and all other insurers, no minimum required. The CEA offers up to 25% mitigation discount, subject to the age of your house and it being retrofitted for earthquake. All policies have a deductible, state minimum 15%. CEA offers 5, 10, 15, 20, and 25%. But note that policies with coverage A limit over $1 million, greater than $1 million, or homes built prior to 1980 that are non-retrofitted do not have available the 5 and 10% deductible limit. And then finally, state minimum for building code upgrade is $10,000. The CEA has options of 10, 20, and 30,000 for code upgrade. Would you go to the next slide, please? All right, so we'd like to ask you some questions around our product structure, and we'd like to get your feedback. The first question is around coverage. What are the most important components of coverage in a catastrophe insurance policy? And some of the sub-questions: should a catastrophe insurance policy be structured differently than a standard consumer or personal lines insurance product? And how important is it to have catastrophe cover that completely restores your home to a pre-catastrophe condition versus coverage that restores a home to a functional and livable condition? So we'd like, anyone please jump in. We'd like to hear your opinion on those questions.
I do not see any raised hands at this time.
All right, and let me repeat I think one of the primary question is: should a catastrophe insurance policy be structured different from a standard consumer or personal lines insurance product?
Doug had his hand raised. Sorry, George, to interrupt you, but I think Doug actually raised his hand, and David Schaefer was next.
All right, thank you, Doug.
Yeah, thanks, George. Doug Heller with the Consumer Federation of America. Just very briefly, as we begin to think about this, we tend to believe that consumers in California are looking for insurance coverage for damage to their home. That is, they don't think about an earthquake as different than a wildfire or a home fire or something else, and are looking to have coverage that is a comprehensive coverage for their home. We no longer have all perils coverage, but that doesn't mean people don't want all perils protection. So our view is that as much as is possible, we should be aiming to provide homeowners insurance coverage that covers damage from earthquakes, rather than think of earthquake as some exceptional coverage that only provides for some for this like severe catastrophic exposure, and even that with really limited protection. So we view an objective as trying to get as much normality, if you will, from a consumer perspective in this product as we can, and that's really going to be part of our goal and our, as we think about this restructuring.
Appreciate it. Thank you. Yeah, thank you for that. Appreciate that. David? David Schaefer, you're on mute. You had your hand up.
There we go. All right. Good morning. My name is David Schaefer. Actually, let me just quickly change my background, because I am an independent insurance agent, and I'm on the front lines of offering coverage to California consumers, and I deal with this issue on a daily basis when I talk to my clients about what type of coverage is important to them. And I've been offering earthquake insurance for at least 40 years here in California. So on the coverage components question, I believe always in offering coverage for the full rebuild cost of a client's house. But one possible solution for that, I think the CEA should maybe consider this, is to give consumers options. So for example, I'm not mentioning names because of the first part of it, we have to be careful what we talk about. One of the competitors to the CEA offers an option for buying a lower limit of coverage. So maybe one workaround to not offering the full policy limit, is as follows: give consumers a choice, let them buy up to their current dwelling limit on the homeowner's policy, but if they don't want to buy that full amount, give them the option to maybe buy 50% or whatever. So maybe there's a way to look at what if consumers want to buy a lower amount of coverage as an option, not being fully protected. See how you can figure out mathematically what that would look like. On community resilience, my thoughts are, and one of the questions I sent in advance is, I believe in not just making insurance the solution, but also risk management. And what I mean by that in the context of the CEA is earthquake retrofitting. I don't know if the CEA has done any studies to determine if more of the homes that are insured through the CEA are properly retrofitted, how much lower the probable maximum loss will be by having more homes that are resilient to earthquake damage. So, and I think homeowners should be participating in the process of making their homes more earthquake resistant, just as I think homeowners should participate in making their homes more wildfire resistant to help solve the home insurance crisis in California. So what can we do to help consumers retrofit their homes to reduce the amount of damage to their homes? So I have a strong feeling about earthquake mitigation is not, so homeowners need to have more skin in the game, so to speak. Capping coverage, my thought about that was when you mentioned the NFIP only offers a maximum of 250,000 total for flood coverage. So I don't know what the CEA is thinking about what that cap would look like in California. Personally, as a professional insurance agent, I don't think it's a great idea to cap it, especially if you can only cap it at 250,000, because I don't know many homes in California, if any, could be rebuilt for 250,000. But getting back to my first comment about coverage components, maybe the workaround is letting the consumers have the option to buy to the full policy limit, and also an option to buy 25% of that or 50% of that as a workaround. So those are the brief comments I'd like to make about the coverage. Oh, and one last thing I want to mention about coverage components is the building code issue. If you're insuring a home today in California, no matter what year it was built, the value on the policy today should reflect a home built today to meet current building codes. And CEA has an internal limit of 10,000, 20,000, or 30,000 as the options for building code coverage. And it's impossible in my conversations with professional builders to know how much a homeowner might need to bring their house up to current building code standards. So I'd like to see the building code sublimits eliminated completely. And part of the total coverage limit on the house should be any code issues that have to be complied with to bring the house up to code after the earthquake damage occurs should be covered fully up to the dwelling limit of the policy. I think that would help consumers and help even making the adjustment of claims go a lot quicker and smoothly. So that's the coverage change I'd like to see. Eliminate the building code sublimits of 10, 20, or 30 as the options and just cover all the building codes, things that have to be done up to the dwelling limit on the policy. Thank you.
Thank you very much, David. Appreciate that input. I don't know who's next, so I'm going to go left or right. Karen?
Thanks. Karen Collins with the American Property Casualty Insurance Association, or APCA. Just a couple thoughts, and they're kind of maybe more conceptual in nature. With regard to the individual coverage components, I agree that it is ideal if we can maintain a structure that is more similar to a personal lines insurance product where it has the different pieces of coverage for dwelling, for contents, for additional living expenses. I think in the context of the peril of earthquake, the contents coverage is probably viewed a little bit differently than, say, maybe a wildfire or a flood, where more of those contents are fully lost. And so with an earthquake, generally in a more smaller to moderate earthquake, many of those contents may still be in the home and many of them intact. Some obviously breakables are going to be more impacted, but from a contents coverage, I think that is a lesser of a priority than the structure itself. And so I'll just maybe flag that. One other consideration that as I mentioned, is kind of more conceptual, and I don't know if you guys have thought along these lines, is with the potential for the very, very significant earthquakes that are far more catastrophic, where the entire region is destroyed to the extent that reconstruction is not going to happen in the immediate term, simply because you're not going to have the infrastructure. You're going to see a lot of displacement where people are going to have to move to other areas, other regions entirely. In those cases, the concept or idea of a replacement policy and trying to reconstruct in that region is probably going to be less of a priority for some consumers as they seek to just relocate. And so how you structure that, I don't have an exact solution or suggestion, but I feel that there should be consideration given to those very, very extreme high, scale events, and what could the coverage design be after a certain magnitude of an earthquake that would enable more of a relocation benefit than a reconstruction benefit, if that makes sense. Trying to think of where I was going to go with this. We have a lot more technology with like parametric policies. And so I don't know if there's a way to do a hybrid where there's more of like a parametric benefit that could allow something that is to go elsewhere versus reconstructing here, or if that could be something that could be blended in some capacity with what is a more traditional policy. I know that we're seeing a lot more technology with obviously trigger-based events, and earthquakes fall very well under that. And so if we're thinking kind of conceptually and how to reinvent maybe the coverage structure, I just wanted to kind of plant that seed for conversation if there's opportunities that might exist there.
Yeah, I appreciate that feedback and those comments. I've managed claims for a while, and I've seen in wildfire in particular where rebuilding isn't automatic. It is not automatic. There's a lot of work to do. Do you think most consumers would agree that the focus of coverage should be more on building than contents than their personal property?
I think in earthquake areas, the structural damage that can happen with a property is, if you're going to have people remain in their homes, that's going to be the more critical piece. Those pieces that can be salvaged that are contents, people will pursue those, but if they can remain in their home, that's going to be the more, I think, critical component of a policy. just the infrastructure of a community, though, if something is so extensively damaged that you're just not going to be able to go in and rebuild, and even trying to, from a reconstruction, claim settlement approach, an event that is of that size and therefore such a wide region that's impacted, even from a claims handling perspective, trying to do everything from a replacement cost where you go through the individual itemization of everything and structure, like all of that's going to be extremely complex. And that's why I think that there could be the opportunities for a parametric kind of complement maybe and some sort of coverage design just for those really, really significant events.
Yeah, I appreciate that. I'm very familiar with the complexity of large loss and inventory contents. I fully agree. Thank you very much for your question, Karen. Sarah, you're next, I believe.
Sure. Thanks, George. Good morning, everyone. Understanding that this conversation, we're talking about these things separately, product structure and such, but it's all really taking place under the context of, CEA's long-term financial sustainability and all these various trade-offs. And I know over the years, the board has had some discussions about, what is the right structure. And, we've sort of said that the original arguments for the CEA mini policy still apply today. A CEA policy should have coverage sufficient to repair or rebuild a dwelling after the earthquake. The need for the non-structural coverage is less. I think some ALE, additional living expense, to provide sufficient time to develop and move forward with the plans to rebuild is warranted. And then the personal property coverages really have been driving unwarranted financial pressure for the CEA. And so as you think about product structure, obviously there's trade-offs that are involved with with how that drives the cost of the policy and some of the other questions that you're going to get into around take up and other things. So just some thoughts there.
Appreciate that. David, you have a follow-up question?
Yes, I do. Based upon what I listened to, what Karen was just talking about, I'd like to bring to everyone's attention that under the homeowners policies in California, and I can't cite the chapter and verse, so forgive me. I know there was some recent legislation that allows the homeowner after a total loss to either take it does not require you rebuild in the same location. You can take the money from your homeowner's policy to rebuild in a different location, or you can cash out. So I don't know exactly under the way the CEA homeowners policy, the form was designed, if it currently allows the homeowner with those same options that applies to the homeowner's insurance. So, someone hopefully can answer for the CEA product. If there is a total loss, can today, that happened as we're speaking right now, hopefully it won't, but could a homeowner take the money from a CEA policy and rebuild elsewhere? So I don't know if that's possible or not. And if they don't want to rebuild, just cash out at, if it's actual cash value, whatever that means, because I've always kind of wondered how does a claim get adjusted at the actual cash value until you rebuild? It's been a mystery to me for many years, and nobody seems to be able to answer that. So those are some possible solutions to what Karen's concerns were. And regarding the contents limits, obviously in a massive wildfire, you're looking at total losses and everything is destroyed. And I've had clients who have suffered total losses from wildfires. I don't recall the last time, if actually ever, even down in Northridge, I was down in LA when the Northridge earthquake happened. I live in the Bay Area. I think it's very unlikely for many homeowners to sustain total losses to the personal property in their homes. I think that would be highly unlikely. Or very, very, very few homes would have a total loss involving all the contents of their home. Of course, unless a fire follows, if a fire follows, then it becomes a fire claim, not an earthquake claim. So in terms of limiting coverage, as a professional insurance agent, I would be okay if you don't have the ability to buy up to the full limit you need for contents, unless you want to offer that. I know the current limit, I think today is either 100,000 or 200,000 maximum for personal property. Let's go back and look at that chart again. But to me, the structure itself and being able to rebuild it or take the money and use it to buy a house elsewhere or build a house elsewhere would be the most important thing. And the contents is not as crucial unless the homeowner feels that way. So, but in terms of helping the CEA sustainability, to me, the emphasis should be on the dwelling itself. And I'm not as concerned about full limits on personal property, and people are welcome to disagree with me.
I appreciate that. Appreciate that. Our policy does follow that legislation where you, as you described, you don't have to rebuild your house where it was. And our max contents limit right now is $25,000. So we really are focused on the building and not as much the contents. Thank you very much. Doug, you had another question?
Just very briefly, just a comment on the contents issue. As you just noted, the CEA has reduced the contents coverage down to a maximum of $25,000 now. And we, the Consumer Federation of America, have heard specific complaints from California consumers that they don't feel comfortable that that's enough for them. And I understand David's point that you may not, that an earthquake, even a total loss earthquake, may not have that same contents damage at the total loss level. And we were at CFA, in comments we've provided to the CEA, we're okay with moving from that maximum limit, that higher $200,000 contents limit down, but we think that $25,000 is insufficient for somebody who sustains a significant earthquake damage. And we don't think that realistically it will be able to cover the needs of a family or many of the consumers. And we're concerned that it really dissuades consumers from joining up with the policy, who feel like they do need to be able to have a refrigerator and a kitchen that's working afterwards. And it's very expensive to buy a kitchen that's working after a quake. And we were of the view that $25,000 was too low, even though we were sort of accept the fact that $200,000 may be an unnecessary burden for the whole book of business to be able to sustain a reasonable premium. So I just will reiterate that we think that the CEA should revisit that number and include a higher coverage limits for contents.
All right. Appreciate that very much. Robert Harrell.
Harrell, thank you. With the Consumer Federation of California. Good morning, everybody. Two quick things. One, to just echo the point that Doug just made, which is why I had raised my hand a couple moments ago anyway, that 25,000 feels too low. And I won't reiterate the other things that he said, which we agree with. Also, per David's point, George, you partially answered the question. Yeah, that law, if I remember, I'd have to clear the cobwebs. I see Joel on, he might remember as well. 2018, I think, is when that law occurred, because it was part of the package that was sponsored by the Department of Insurance coming out of the 2017 fires, to give folks the option. And I remember being involved in that. I'd have to refresh my memory on the details of it. But George, you kind of dealt with it to the extent that you essentially said that you mirror that and are aware of that, and that's built in. I'm putting words in your mouth there, but paraphrasing. So with that, I'll shut up. Good to see everybody.
I would just add, just in terms of the policy, that that's actually always been the CEA policy has always provided that for many years, long before the law that you were talking about. The CEA has always provided the benefit where you can rebuild the home in whatever location you want. And if you're unable or if you don't want to rebuild, then we will pay the amount that it would cost to rebuild the home at the insured location. And you can take that money and do whatever you want with it and not rebuild.
Thank you, Joe.
And hi, Tom Hansel, CFO at the CEA. Just wanted to note, when we did reduce the coverage C amount from $100,000 or a couple $100,000 to $25,000, we worked with our participating insurers to make sure they knew and their policyholders knew that we don't see the other players in the market, the primary ones being Palomar and Giovera, as competitors. We need all the capital and all the providers in the state, and even new ones to come to the state, to provide the coverage for earthquake. So we're very happy with it. And I just note that their coverage, which our policyholders could access through independent agents and even through the participating insurers distribution channels, offer materially more than even the $400,000 or $200,000 of coverage C we used to. So we try to work with their distribution teams of the participating insurers to access if that's something they need, as we try to manage these competing objectives and make sure that we can, at least in the interim, provide access to other forms of insurance if that's best for their policyholders. So just wanted to add that note. Back to you, George.
All right, Karen Collins.
Yeah, I just wanted to kind of way back in and maybe clarify when I refer to being able to rebuild in a different location. I think the last comment that was just made is that it's based on what the cost would be to rebuild at the insured location that then allows you to go and buy or build new somewhere else. And I think that is the challenge, is that in a really, really severe high magnitude earthquake where the entire region is devastated, the ability to identify what is the cost to rebuild at that insured location. And in a smaller event, mid-size event, people are going to be rebuilding, and there is going to be a frame of reference of a price point. But when you're trying to consider from a claims practicality standpoint in a very, very widespread catastrophe, there is not likely going to be rebuilding happening at the insured location. And so that's kind of that consideration of, do you go through that entire kind of process of back and forth and trying to understand that, versus would a parametric sort of structure be an easier approach to that in that scale of an event? And that's why I was kind of trying to plant that seed. So it's good to know that the policy provides for that opportunity. It's just, what does that logistically look like in the claims handling part of that experience? And if there's any change in product design that would make that a smoother outcome for both the CEA staff as well as the consumers, the policyholders.
Very good points, very good things to consider. And by the way, when the question below capping coverage, like flood insurance, we didn't have a cap in mind. So I think David mentioned the $250,000. Our question really is, and maybe we can kind of get moving to that question. Could there be a cap at all? Doug, you had your hand raised.
Yeah, I'm so just very briefly, just a response to Tom's point about alternatives in the market. Of course, we encourage consumers to shop the market. Those other companies do not take all comers. They do not provide coverage for everybody. So that option isn't really always there. So I just want to highlight that. I just think it's important for us to remember that the CEA, it's a balancing act, obviously, but the job is to be there for everybody, and the other companies don't have that obligation. And then as to Karen's just point a moment ago, I'm not sure if maybe I'm not tracking her point exactly, but it does strike me that we have a dollar figure because we have coverage limits. We pay for coverage up to a coverage limit. So there's your number. Like that's the cost of rebuilding. The CEA through the participating insurer tells us what the cost to rebuild is in advance through by having a coverage A limit. So it strikes me that we have that number is sort of figured out in advance. And then as for the capping coverage discussion, I think this is an interesting one. I think I've talked about it with folks at CEA in the past, and a difficult one. Obviously, not obviously perhaps, but the NFIP coverage is far too low for California. It's and I wouldn't even want to have a discussion around a $250,000 policy. But perhaps there's a good reason to think about the give and take around a much higher limit, maximum cap. We're willing to think about it. I don't know where that number is, but it's nowhere near the 250 because that just doesn't fit with the market in California, the cost in California. So
appreciate that, and thank you for pointing out we are a take-all-comer entity where with very few exceptions, if you have a primary policy with a participating insurer and you don't have existing structural earthquake damage, you're eligible. And as such, our risk is maybe a little different than some other carriers. I think Joel, good to see you. Did you have your hand up?
Yeah, I'm still considering this issue of offering people the option to buy something less than the full replacement cost of your home. And whether that's Karen had mentioned previously, obviously you'd have to kind of push aside the co-insurance deductible and kind of come up with a whole different product. But we know there's a very low uptake for full earthquake coverage, and yet we could have widespread damage and then no coverage at all for many consumers or homeowners. And so it does seem like something that could patch up a home or give a person a chance to kind of figure out what they want to do next at some significant limit would be valuable, but it would be a whole different thing than what the CEA is currently offering. So,
guys,
who should offer it?
I'm sorry, I just want to interrupt just for a second, just to point out that this has been a great discussion, don't get me wrong, but we are at 40 minutes past the hour and we're only on our first slide, as it were, which is great because it's so engaging. But I just want to point out, sort of give you guys a time check that we've got a couple of other issues that we want to tease out and get your thoughts and opinions on. So if you could just bear that in mind as we move ahead and wrap up perhaps this section and go on to the next slide. And as Tom mentioned at the beginning, we do have another session planned where we could possibly revisit this, or maybe even at the end of the time for this event. So that was just my time check.
I appreciate that. We would like to, this is a good conversation, so we would like to, a little more input. Dennis Burke.
Hi, thank you. Dennis Burke, the Reinsurance Association of America. I apologize for the background. I'm in a chemo infusion center, so please forgive that. We've been talking about all these factors, and all these factors relate to, costs and expenses of the NFIP and its financial structure. We just need to keep in mind that whichever policy structures we choose, we want to include and think about how does it affect the reinsurance market, stability in product design compared to how the catastrophe models work, et cetera, will be helpful because it reduces uncertainty. One of the points, and Joel was just talking about this, is that, restoring a home to its pre-catastrophic condition has, potential litigation impacts and what is perfect, et cetera. So that has one aspect. But what is a functional and livable condition? Is that a standard that is known in the insurance industry? Is it a standard that is known in the litigation community that exists in California? So you need to think about all of those little components as how they work, in addition to, just from the financial standpoint, and I know you are, Tom, but it has to be considered in addition to the perfection of a policy from a homeowner's standpoint. That's all I have to say on this point. Just want to make sure. Oh, and there's the timing of it. When you roll things out, you need to roll them out in sufficient time for the reinsurance market to respond. And you in the CEA, as I understand, are in the market essentially year round. Sorry, excuse me, this morning. Thank you.
Appreciate that. Yeah, any decisions we make around the policy, obviously, we consider many things, including our insurance. Maybe we go to that last question, piece of change, which we'd like to get your input. Should we do it in small incremental changes, or one comprehensive restructure? Is there a preference? Should we make many changes? David?
Well, I'd like to make some quick comments about the coverage components and the rebuild issue. Then I'll talk about the pace of change. There's one, I think now that I see the 25,000 contents limit is all that's being offered, that is low. So I think that should be reconsidered. I can't, I like the 200,000 as that we had before, but I don't know what the right number would be. And also the other markets in California, I can't mention their names, they do offer higher limits if you're eligible. Doug made a good point about those other companies don't accept all comers, but they do accept a lot of people would qualify for those products. And the last thing about, getting back to Karen's comments about rebuilding, I believe still, and I think United policyholders would agree with me and many others, I was a founding member of United Policyholders many years ago. There's still an underinsurance problem in the state of California. Just recently, Farmers was sued by the district attorney in Alameda County for homes being underinsured today. I still think that's going on. So even if you could buy up to the policy limits for your earthquake insurance and then your house is destroyed, that homeowner still may find out they're underinsured. So the insurance issue for being able to rebuild gets back to the homeowner's policy, where I believe many homes in California are currently underinsured. So we need to get homeowners a way to correctly figure out what it costs to rebuild their home, and on their home insurance, bump up those limits. So when they buy the earthquake policies, they also have enough limits for that. But one more thing to consider is after a catastrophic event, the cost of construction because of surge demand and supply and lack of resources and things are just, the freeways are destroyed. The costs of construction are likely to exceed policy limits for a total loss, and consumers just have to be aware that the earthquake policy may not be able to respond fully ultimately in a massive event. Just probably impossible. Pace of change, well, I don't know, that's timing on your side as you calculate all the numbers to figure out what the CEA needs to do to retain its financial ability to pay claims. I don't know how that looks like on your side of the desk as you figure out all these variables at play. So obviously the sooner the better, so we can have a strong CEA would be the best option, is push it forward as fast as possible, but intelligently and carefully.
Thank you for the, hello, Kate, good to see you. You have a question? You're on mute, Kate.
Just a comment that kind of addresses all of these. So Kate Stillwell, founder of Jumpstart Insurance, we brought small limit parametric to the market. And I am a licensed structural engineer and also a licensed insurance agent. By founding Jumpstart, we talked to a lot of folks, most of whom are not CEA customers, some of whom are. And I say, from my perspective with all those hats, I'd say that the CEA has done its job to stabilize the homeowners market, the original mission. And right now, the crossroads is stay the course or do something wildly different. And if doing something wildly different, do it all of a sudden. But staying the course, it means that there's going to be a maximum amount of uptake, somewhere around, I think we've reached the limit of the people who have the financial resources to be able to pay for a full limit policy, who go through the traditional distribution channels. I think the choice of those two options is going to affect which distribution channels. If the distribution channels are reliant on the traditional agents and the traditional sales process, then the customers will be expecting a normal looking policy like Doug's very first comment. But if the CEA takes the opportunity to do something wildly different, then they have to think about what are the other distribution channels that we can tap into to be able to access this other uninsured part of the market. Because the wildly different approach, the purpose of that, it seems to me, would be to address the underinsurance. It would be an overhaul to address a different segment of the market, and the different segment of the market that isn't sort of have their preconceptions about what insurance is and does and how they should buy it and what they should pay for it, needs to be accessed in a different way. So that's a big mandate, and it's potentially a big change to what the CEA does and what its purpose is. But it has the potential to forge a new type of relationship with different types of distribution partners, and a new type of relationship for the stability of reinsurance, especially if the uncertainty can be capped on a new policy design. I think I'll pause there.
Yeah, appreciate that. Thank you for that input. All right, I don't see any other hands up, and in a time check here, I'd like to introduce Shauna Ackerman, our Chief Risk and Actuarial Officer, who will talk next about policy growth.
Great. Thanks, George. Actually, Kate did a great setup for me herself, which is if you go to the next slide, let's talk about take-up. So this is a historical view of the take-up of earthquake insurance in California from a data that the Department of Insurance collects each year, going back to 1996, where you see the high water mark of 31.4%. Again, recognizing take-up here, and whenever we talk about it, means the percentage of policyholders that have a residential policy and also have an earthquake policy. There are people that do not have any underlying insurance, so it's not representative of the total take up of all Californians, but rather those that have residential insurance. How many of them also purchase earthquake? So coming out of Northridge, there was a lot of interest in earthquake insurance. There were then significant rate increases that were asked for across the market, and ultimately in late 1996, December 1st, 1996 to be exact, the CEA opened its doors. And you see the declining take-up rate that is for the entire market, CEA included, but we represent about 2/3 of the market. And it just continued to go down. And as Kate said, it's kind of flattened out around the 13% mark or so. So that's just the context to provide for this next conversation on policy growth. Go to the next slide. Again, we have a series of questions. We'll focus on the take-up rate portion of it first, and then I'll switch it over to Tom Welsh to talk about some marketing materials. But if we could focus just on the take-up rate and the growth first, and that essentially is what would be an optimal take-up rate for the state. How do we get there? And if we have to deprioritize something else, what objective do we deprioritize to achieve growth? And then also what your thoughts are on the role that other insurers could or should play in increasing the earthquake insurance take-up rate. And one thing I will note as far as the coverage limits, Tom Hansel, I think, and George both noted that there are other insurance companies out there that provide higher limits. Our own participating insurers could provide higher limits than what we offer. They just have to offer what we offer, and then they could offer something additional. So there are options out there currently in statute. So with that, I'll open up the floor. And I don't see any hands. That could just be my technology.
Doug Heller has his hand up.
Go ahead.
Yeah, thanks. And I tried to delay putting my hand. I don't want to step on other people's toes. I want to answer just one sort of part of this question. I have other thoughts, but just briefly, because both Karen and Kate have sort of offered the idea that maybe we need to be rethinking this, and this is an opportunity that the CEA has created to have a kind of a more expansive discussion, which I appreciate. So I just want to answer that first question in a way that is not entirely tongue-in-cheek, which is, the target is California's optimal earthquake insurance take-up rate is 100%. Because earthquake is a peril that Californians face. We would want everybody to have coverage for that. And I understand we don't even have 100% take-up rate on homeowners insurance. CFA, Consumer Federation of America, has done some research, issued a report recently, which places California in a pretty good position in terms of take-up, with about 95% of homeowners reporting coverage, or 94 might have been. But in any event, if we were to think about that, what that would mean, in all likelihood, something like a doing away with the CEA and bringing earthquake not just back into the homeowners policy, but back in as a kind of a mandatory coverage. And that would undoubtedly require some pretty significant changes to the market place, and probably the reinsurance marketplace as well. But I just want to note that if we are really thinking expansively, we should be thinking about what other ways might we get coverage for homeowners to address all the perils that Californians face. Just like we have wildfire coverage, even a catastrophic exposure coverage in the homeowners policy, I think we should be at least know that there is a version of this discussion that includes having earthquake as a mandatory covered peril in the policy. So I say that knowing that that's probably not on today's table, but I just don't think that we should limit our sort of perspective beyond to exclude the fact that that's what Californians want. It doesn't mean we want to pay for it, because we understand it's expensive. But when you talk about what people want, is they want insurance coverage that will help them rebuild in the case that they lose, their home is damaged. We don't think in terms of, well, we don't mind if we get damaged by an earthquake, so we don't need coverage for that. People think, I want to be able to live in my home tomorrow as I do today. And so I just think that that's part of the discussion. I'll leave it at that, just to throw that out there in the spirit of Kate and Karen sort of kind of expansive thinking, but just wanted to note it.
Thanks, Doug. So just so I understand, I mean, would you advocate for mandating earthquake insurance?
Yeah, I mean, there would have to be a complete reformulation of insurance structure. But yeah, we would. I mean, if you've seen things that we've written about the idea of collapsing the NFIP and CEA in exchange for the creation of public reinsurance facility that would help offload some of the pressure, and then would supplement the private reinsurance market to offload some of that pressure. And in conjunction with that, by taking some of the top exposure off of the books of the direct insurers, have them provide coverage on an all perils basis. And that we think would achieve a resiliency objective that we all have, that is not achieved through the current structure of bifurcated or trifurcated, or whatever the word may be, for what we have. So yeah, that's what we would encourage. But it's a longer term project. I just don't want to not have that be in our minds, because I think we should get there. We should aim for that, because if we want to be resilient, it's going to be not just to the effects of climate change driven catastrophes, or but also earthquake driven catastrophic losses, and be able to come after to bounce back from that.
Thank you. Let's see, next up on my slide is Joel. Hello, Joel.
Hello, Shauna. How are you?
I'm well, thanks.
I think one thing we should also keep in mind, you showed that the take-up rates dropped down to around 13%. And in the homeowners market, we're having kind of a significant moment of crisis in finding affordable and available insurance coverage. And the proposals from the Department of Insurance would be to change the regulations applicable to rates to allow reinsurance costs and wildfire model loss projections to flow into the fire rates for homeowners policies. And I think that's likely to significantly increase the premiums for homeowners policies, especially in a lot of regions, and potentially then lower the take-up rate for earthquake coverage, which is already very low, as your chart indicated, Shauna. So I am a little worried that, having an expansive earthquake coverage, and then with these intended or projected moves in the fire business or fire coverages, we're really going to have a very challenging market for consumers by the end of next year in terms of affording coverage at all. So that may kind of lead to not wanting this fulsome earthquake coverage that we've been talking about. That's
Thanks, Joel.
Concern. Thanks.
Yeah, no, we've long noted the discretionary nature of our product. Kind of where the last check that gets written at all, right? So I appreciate your comments. Dennis Burke, I see your hand is up.
See if I get this right. No, there we go. Thanks, Sean. I was just going to comment along the lines of what you just said, the discretionary nature of your product. I mean, the market failed because of mandates. It was stabilized as a result of having the ability of carriers to transfer their mandated obligations to the CEA, to transfer that mandate back to consumers, to insurers, would need to be done with their full consent, unless you wanted to create other problems. And since we're talking about the purpose of this this convening that you've brought us here for, I think the idea that we would, want to go to undertake the possibility of a multi-decadal attempt to get the government, which is a 50-state government, which can't pass almost anything, for people who do not have the high catastrophic risk of California or some of the coastal states. Those states have not been heretofore willing to undertake a government program that would back catastrophes, and I besides the NFIP, and I don't think you could pass the NFIP today if it didn't already exist. So I think for your idea of coming up with a 5 to 10 year or strategic plan for the CEA, I think leaving that one on the side would be beneficial. And you have a participating insurer advisory board. You could ask them how they feel about a mandate putting all of the earthquake coverage back into the homeowners policy, and my guess is they wouldn't like it. Thank you.
Thanks, Dennis. I just want to clarify for anyone listening, just one minor thing, which is our advisory panel includes insurers, it's true, but it also includes consumer advocates and other professionals. So let's see, David Schaefer, it looks like you're next up.
Thank you, Shauna. And listening to our great conversation this morning, a couple of things since I'm on the front lines offering earthquake coverage to California consumers. Number one, not everybody wants earthquake insurance. That's the reality. I think consumers like having choices, and to be forced to have something you don't want to have is not a good idea. So I think we need to have choice and not have it mandated. Number two, not every area of California has a high concentration of homes and has a high earthquake risk. So the likelihood of earthquakes damaging every part of California substantially is not likely. So that I don't think everybody in California has to have earthquake insurance, and not in addition to not even wanting to have it. And lastly, this all talks about the optimal earthquake insurance take-up rate, as if insurance is the only solution to this problem. I want to emphasize again risk management and earthquake retrofitting, that consumers should be proactively making sure their homes are properly retrofitted, because I've talked to a great firm in Albany, California, Bay Area Retrofit, and the co-owner Howard Cook has informed me that if homes are properly retrofitted, the damage from the earthquake should be more sustainable. The homeowner should be able to handle the minimal less damage that's going to happen to a properly retrofitted home. So we're assuming that people are going to have catastrophic losses of their homes as is today, but if we can get the homes themselves better, more resilient, like we have wildfire hardening, everyone wants to do harden your home for wildfire, but let's harden your home for earthquake damage, because if we reduce the likelihood of the structure being substantially damaged, that's better for everybody. So I think part of the conversation needs to emphasize to the homeowners, earthquake insurance is not the only solution. Getting your home properly hardened to minimize earthquake damage also has to be taken. And how do we help homeowners afford that? The CEA has offered a very small amount, a couple $1,000 for earthquake retrofitting, which doesn't seem like a lot of money to do the work that's required, but maybe there's a way to provide more funding to homeowners to do the correct type of retrofitting that will indeed reduce the structural damage to the house. So just getting people to buy more earthquake insurance and having a higher take-up rate, to me, doesn't make sense, focusing just on buying more earthquake insurance. We have to emphasize risk management, meaning proper retrofitting and hardening the home to make it more resilient from having a lot of earthquake damage. And somehow that has to be part of our.
No, we are huge advocates of mitigation and retrofitting, and the California Residential Mitigation Program, which is a partnership that we have with the Governor's Office of Emergency Services is what I think you're talking about as far as the grants that are provided. 3,000 is a typical grant. We have new programs for low income homeowners that could cover the full cost of the retrofit. We are very, very much an advocate for retrofitting, David. And if you want to lend your voice to the legislature to get more money, that would be fantastic.
Okay.
So with that, I think we might move over, seeing no hands, to the second part of this conversation. So I'll hand that off to Tom Walsh to talk about the marketing.
Thanks, Sean. And actually, going back to David's comment, among the things that we think about as a policy matter around mitigation are, for example, should the state mandate retrofits upon sale of a house? Because there are a lot of houses that clearly need to be mitigated and seismically strengthened that trade hands. And so there's opportunities to facilitate that. That's not really a CEA mandate or a charge immediately, but certainly those are the kind of policy issues that these kinds of discussions are designed to stimulate, so we can all think about it. And we don't have to spend too much time on this piece. As I think most people know, a number of years ago, a statute was passed that creates this mandate that you see on the slide, that each year all of our 20 participating insurers have to tell their residential property insureds or provide them with a marketing document that we provide and pay for the distribution of. And it's a very short statute. It's an absolute mandate. And we haven't necessarily been able to correlate that messaging to either additional take-up or even enhanced focus on mitigation. So we had introduced a topic to the board back, I think, at our March governing board meeting about possibly going to the legislature and creating a little more flexibility within that statute to, rather than have it be a mandate, put the board in the position, or the CEA management in the position of deciding when it would be appropriate to target homeowners with some additional materials about earthquake insurance or even mitigation activities and opportunities. And the board's suggestion was, let's wait, let's actually build this into the stakeholder engagement program and see if anyone has thoughts about the value of that kind of written communication or email communication from the underlying homeowners insurers. And so this series of questions is just to see if anyone has any thoughts about the value and effectiveness of the current program and whether we should potentially seek some modifications or not. Hi, Karen.
I'll maybe jump in. Yeah, Karen with APCIA. In the context of wildfire, I know that we are doing a lot of outreach. You'd mentioned the real estate transaction, which I strongly feel that is a really great opportunity to target mitigation opportunities for the existing housing stock. And that probably translates to earthquake as well. I think more so on wildfire simply because of emotional attachments to vegetation and defensible space. But I think that there's opportunities similarly for earthquake at both a new real estate sale, new home sale, as well as a change of ownership sale. And that really ties back to the fact that financing could potentially be incorporated into the cost of a new mortgage origination and then spread over whatever the time period is of that mortgage balance. So there's a lot of attention discussion within the financial services industry right now on potential mitigation related financing structures. And I don't know where they are at with that, in the context of maybe for earthquake specifically. But aside from obviously grants and tax credits, that could be another opportunity from a funding perspective that you might want to look into and see if there's opportunities that might exist there. As far as the messaging, I think that the marketing, as a California resident, I receive those documents, and I think it's a helpful reminder if it's not already being done at new home purchases, new construction. Obviously, a new construction would probably be retrofit, but for new mortgages that are sold for a change of ownership, I don't know how much opportunity there could be to expand some of that, maybe including resources that point people to where the most active earthquake fault lines are within the state that they can look into and have a better understanding of the risk, not just that there is exposure, but kind of where are they in context relation to where some of these higher risk fault lines might be, or something to that effect. So I don't know if there's opportunity there, but maybe that could be an opportunity.
Thanks, Karen. I like the idea of thinking about expanded flexibility to talk about multi-peril exposures and not just necessarily limit us. But Joel, hi Joel, good to see you.
Hey Tom, good to see you as well. I would say that I've been doing a lot of community presentations in person in the last couple of years, and I frequently hold up documents that talk about not being underinsured, or checking out your coverage, making sure you have these things in place. And I ask these communities, have you ever seen these documents? Do you receive these? And people shake their heads no, they've never seen these things. And I then remind them that they are mandatory enclosures in your insurance policies, and you get some of them every year and some of them by law on an every other year basis. So it really tells you, beyond paying the bill, how little people delve into the other documents of their insurance policy, and until they have to. So I do think advertising materials enclosed in policy forms aren't as effective as trying to reach other through other means. So I do think the other channels, I don't know the best way to approach people about insurance coverage, but I agree with one of Karen's last comments there about maybe highlighting to the people who are most at risk that they do have a higher risk. So it's just not a broad-based part of it, but there should be a little more specificity. But it's definitely challenging, but the enclosure in policy forms isn't the most effective.
Got it. So added flexibility is something that you think would be helpful to us.
Thank you. Thank you.
Why don't we go ahead and pivot, because this will be a longer conversation throughout the rest of the year. There are other stakeholders that aren't here. The realtors are an important voice in especially if we start thinking about mitigation mandates for unmitigated houses upon sale. So that discussion will continue. The second, and in terms of timing, as you know, this is a series of discussions. So if we end up running out of time, or people need to drop off to meet other commitments, we can continue this discussion into the August session and make sure that all of you have whatever time you need to provide us feedback, whether that's individually in individual meetings, or pick up any of these concepts afterwards. Sustainability, this entire discussion really is to hone in on the fact that we find ourselves, you can go ahead and switch to the next slide, but we find ourselves in a position where we haven't had a really, really large catastrophic earthquake in many years. We've had smaller earthquakes, and we've had claims from those, and we've handled those well and paid those according to the terms of our policies. But we've as Tom Hansel will talk about, we've built up a lot of sustainability and capital in our organization, but we remain vulnerable to impairment from a really large event. And this topic is about how we think about opportunities to enhance our structure, enhance our statutory and financial structure in ways that can increase the likelihood that even after an impairing massive event, we're still here, able to offer new and renewal policies to continue coverage for customers who have been with us for a long time, who have helped us build our capital, but may not have suffered a loss from the large earthquake based on where it happens. So I'll let Tom jump in and talk about the nitty-gritty aspects of our current this current state of our sustainability.
Great. Thanks, Tom. And I see, Doug, you raise your hand. I don't know if you want to jump in first or wait till the intro is done.
Well, it's a technical question that I had about the slide, so maybe you'll answer, but I'll just present it to you. I'm just curious, on the left-hand side, you have the, I believe these would be sort of the current dollar value of those events for Loma Prieta, Northridge, and San Francisco. And I'm just wondering if they are adjusted to account for building code changes and upgrades, or if they're just kind of a straight inflation adjustment to the event as they occurred.
Do you want me to take that one, Tom?
Yes, I was just going to pitch it to you, Shauna.
Yeah, no problem. So Doug, that is our portfolio modeled as of the end of the year based on current knowledge, but they are modeled estimates. So it is going to account for any changes in the underlying portfolio as of 12/31/2023. Does that answer your question?
Well, if I restate it, you can tell me if I understand it correctly, because I think this is important for understanding what we have. You're saying that if San Francisco occurred today with the current building standards and the scale of retrofitted homes, et cetera, it would be $14.9 billion. Not that the San Francisco earthquake had a cost of X, which adjusted to contemporary dollars is $14.9 billion.
That is correct.
Okay, thank you.
Thanks for the question, Doug. Really helpful. So just a couple of levels. That one thing, as Tom's talking about, very important topic, and important topic because of the concentration of risk within the CEA. As Shauna mentioned, we're 2/3 of the earthquake insurance market, granted with a 13% take-up rate. But if something happened to impair CEA's ability to continue, when you are 2/3 of a market versus a smaller player, other entities to be able to consume that vacuum is a little bit easier. So we really want to be thoughtful and come up with some ideas around sustainability. Before we jump into this, just level setting once again, you see here we have these return periods, which is that 1 in 350 years or 1 in 250 years. Just to be clear, which causes some confusion, those aren't additive. So you can't say a 1 in 100-year event plus a 1 in 250-year event equals the losses of a 350-year event. There's actually a 100-year event plus a 250-year event is over $25 billion of loss versus, as you see here, a 1 in 350-year event is 19.6 billion under the models Shauna talked to us about. Additionally, we build a very complex reinsurance structure and overall claims paying capacity structure to, under our statute, build some sustainability into it. And to really understand that when we have smaller events, we want to be able to survive and still be an operating entity who can continue issuing new and renewal policies. And therefore, when you look at our claims paying capacity tower, when we present to the board and other entities, there's a smoothing of the line between the available capital, that blue line at the bottom, blue box at the bottom, and the orange risk transfer, because our reinsurance starts to attach just over $2 billion, even though we have over $6 billion of what's defined here as available capital. So with that said, this chart and the next chart are going to show you basically on the left side, that's a 1 in 350-year event, which is our floor, the lowest amount we're supposed to have based on our mandate from the board of claims paying capacity. And then what's boxed are what the tower would look like under various events, what that loss event would be, and the remaining claims paying capacity and the various components there. So if we took the 100-year event. And so if we had a 100-year event, you'll see that a 100-year event is about an $8.9 billion loss. So we have $10.8 billion remaining. And it didn't blow out all of our capital, as I said. We went from $6.2 billion of available capital to $3.6 billion of capital, with most of the loss being borne through the risk transfer that we purchase. So that under that scenario, we have 130 years of return period claim paying capacity remaining. And so we'll get to, is that sufficient to continue operating or not? But that is what this slide is trying to show you. At each of these return periods of a 25-year loss of 50, 100, 150, 175, and 200-year loss, what do we look like? And what are the components of our claims paying capacity today? If we move to the next slide, this one is to show, okay, well, what if the board said, hey, when we look at these competing objectives, let's reduce our claims paying capacity to 250 years. What do we look like? So under this scenario, we have $16.2 billion of claims paying capacity. The flex there was really just through the reduced risk transfer purchase. So reduced from $8.5 billion to $5.1 billion of risk transfer. If we had that same 100-year event after that, it would basically exhaust all of our reinsurance. And then we'd eat a bit more into our available capital. Rather than having a little over $3 billion of available capital left, we're at $2.5 billion available capital. And that's left with the 76-year return period of claims paying capacity, $7.5 billion of claims paying capacity. And so that is one of the questions I'll get to in a moment, but hopefully this frames how we think about, within our current mandate, what we can do for sustainability. And are there options to enhance that or not? And is there a desire to enhance that or not? So on the next slide, I'll tease out all of the questions and then we can, happy to take questions and input. So really the first question is, we have a statute, as I said, it basically says you continue to operate until you've depleted your capital or materially impaired your capital. So you can't, the CDI basically says you shouldn't continue issuing new policies or renewal policies. So should we seek some sort of statutory change to enhance sustainability or keep as is? The next set says, well, if you say you should really consider this and look into structures around sustainability, then we break it out into, should we maintain this sort of single tower, single fund structure? But are there ideas you all have around adjusting pro rata or installment payments or something else within one structure? Or should we look for a second event tower? Should we build two events? Basically the first event, and then we have some pre-capitalized where we have move capital from one tower to another or some other structure? Or do we just do something unfunded, but it's basically a standby structure that's through legislation that we have a view to how we should look after some large event? And then if it's pre-capitalized, a tough thing to think about is, should it stand alone, that second tower? Should we segregate capital? So even if we have a blowout event in the first, that first event blows out all of our capital, and we have nothing remaining in that first event, but we still have funds in a segregated tower, how does that play with you and your constituents? Or should that be at risk? If we blow out an event, it could just basically bring down the whole sustainability. Or are there other structures that are interesting to you that you could bring forward? And then the final question is, as I teased earlier, what should that minimum claims paying capacity be? What level do you think you and your constituents just look at and say, it's just not right. You're not financially strong enough to continuing issuing new and renewal policies. And maybe that's under return period basis or some other basis. So hopefully that teases it up. Happy to take questions. I appreciate those first two slides are pretty complex, but look forward to your feedback. I think, David, you had your hand first.
Okay, thank you. Tom, one of my questions is, as I think about all these things we're talking about, is on your sustainability slides, you have the ability to create a new slide that shows by region of California where if an event happened in the San Diego area, the LA area, the San Francisco Bay Area, Sacramento, so we could see by region, but when these large events would happen, how would it impact each region separately? So that's number one. And number two, in terms of the, if one event takes out a lot of the capacity, and there's going to be another event, if people haven't watched the movie San Andreas, it was back in 2015 where something I think started in near Las Vegas along the fault line back there or whatever happened, and the earthquake faults go to LA and all the way up to the coast to San Francisco Bay Area. So the likelihood is of in a short amount of time there being two events that would wipe out the CEA is hopefully small, but it does have to be taken into consideration. And the earthquake experts, from what I'm reading, are saying that California in the next 20 years has a very high probability of major earthquakes, both in Southern California and in Northern California. So how do we look at each region separately to see what those risks are if it just happens there? And then, how does it see? I don't know. I mean, how do you have enough capital if, unfortunately, we have a San Andreas type movie event where in a shorter amount of time, both Southern California and Northern California have a massive earthquake that could jeopardize the financial claims about liability of the CEA. That's what you guys have to figure out.
Thank you for those. And given our time, I'll say that we have abilities to model various things by region, and we have the data by exposure by region. And then it starts to get complex of how you build individual towers. But it's something Shauna and working with our CAT modelers is something we do and are aware of, and we'll have to discuss how to communicate that. Under the massive event, whether it is like you're talking throughout the state or even just a singular location, yeah, there are events that will deplete our capital, and there are events that will theoretically deplete any insurer's capital. And that's where some of this trade-off is of saying we could build enough capital to cover that 500-year event, 1,000-year event, San Andreas event, as you're mentioning, but that product will be multiples and multiples and multiples expensive as it is today. And how do you build the rate trade-off? And that's what we were talking about in the prior session of the rate, let's call it the average premium for a consumer versus the amount of protection. And it's part of that whole trade-off discussion. But
it gets back to this whole issue gets back to the mitigation efforts. If these models are based upon things as is today, with homes built the way they are today without a more earthquake hardening. So if you could throw into your modeling, what if more homes were hardened for earthquake damage? How does that lower all these financial on the sustainability charts, going from these events from 10.8 billion, 8 billion, whatever? Can you throw into the computer modeling system, what if all these homes that are higher risk were earthquake hardened for damage? How that lowers the risk as part of figuring out how to make this all work? Because to me, again, just saying just raise the rates, if people can't afford the premium, not going to pay for it. But if we can lower the risk, just keep the damage low and the premiums low, to me that helps solve the problem. But we have to lower the risk for the damage happening, not just say the only way to make enough funds available is to raise the premiums. That doesn't work, because we have to get back to risk mitigation still as part of the broader picture to make the CEA have enough money to pay for claims.
Yeah, fully agree. And it's something that can be modeled, and we can look into that. And I'm sure, I think Shauna has looked at it over the years. So, and we are fully engaged on the mitigation side with you, and look forward to partnering where we can.
And I'm happy to participate in I need to log off in a few minutes to help take care of my clients, but I really appreciate Tom and everyone from the CEA and everybody else at our meeting today for having this conversation. So I'm more than happy as a professional insurance agent to assist you in looking towards solutions. And I'm going to stay on for a few more minutes, but just please note, I have sent to your email address some questions, you'll have my contact information, and I'm more than happy to be part of the solutions that you're looking for. Thank you.
Thanks, David. And mark your calendar for August 1, because you'll have another another opportunity to join and participate.
Thank you, Tom.
Again.
Hey, Saren.
Hey, Tom.
Yes.
Thanks. So much to look forward to on August 1. In any case, I did want to say that, and we've said this before, right? That the CEA's biggest vulnerability following a major earthquake is depletion of, most but not all of its capital, such that it's impaired, and that the Department of Insurance would, allow it to issue new and renewal policies. And we've previously suggested that we should look at restructuring the CEA to fund not only the big one, but also ensure day after funding to support the CEA's continued operations the next day. The idea of if you have that second tower, that second event capacity, I do think it makes sense to keep that separate from the first tower. Obviously, as in all these things, there's trade-offs there. Being that the people in the first tower, if they were getting pro rata and then you had a second tower sitting there and they couldn't get paid from it, they'd be frustrated. But more likely, as noted, those folks would be paid out, and you would just have a situation where the CEA is impaired and can't do business. But if you have that second tower, now the implications, obviously, for the homeowners market, as I think one of the speaker earlier had talked about, the original sort of founding purpose of the CEA to keep the homeowners market from spiraling. And also you get this benefit that, the people who are not impacted by that first event, right? Let's say the first event was in Southern California, and most of the CEA capital is used from the first tower is used to pay out that earthquake. You would have all these folks in Northern California who've been paying into CEA for many years, and they'd have no functional earthquake insurance. But if you had the second tower separated, they would continue to have that. They would continue to have insurance that they'd been paying for available to them. The market would continue to function, and you'd certainly avoid, what would surely become a panicked effort in the legislature and elsewhere to figure out what to do about the homeowners market and the continuing functioning of the earthquake authority. So we think there's a lot of benefit to talking about a two-tower structure with a second tower that would be separate from the first tower.
Thank you, Saren. Appreciate the comments. Doug, do you have some comments?
Yeah, thanks. I'm also sensitive to the time, so I'll be very brief with them, and maybe this can, well, unless you all decide to keep this going a little bit longer, maybe we can take it up next time. But just first on the second tower, well, I think there's real value to one of the ideas that were in that list on the slide deck of creating a kind of a public policy structure for the event of in the event of a devastating quake that damages the capitalization of the CEA, which is I think it's the second bullet point. Yeah, an unfunded kind of standby structure, so we don't find ourselves in the situation we found ourselves in the wake of Northridge, of scrambling and sort of under the pressure of industry's sort of concerns and like we have a more thoughtful approach, or the space to have a more thoughtful approach. I think that's fine. I do not agree that we should have current policyholders use their premium dollars to fund, set aside and unavailable if there is an event that happens during the course of their policy. I just don't think that is a sensible approach. I appreciate Saren's point that there are different people who wouldn't get coverage. That's always the case with insurance, which it's a pooling of resources in the event that any one of us in the pool sustains damage. And I don't think that we should make people pay for somebody else's pool. We're all in this pool. So I just don't agree with that approach. Happy to have those conversations. Just briefly on the point of the return period, we have written several times or communicated several times to CA. We believe the 1 in 350 year event is counterproductive. It reduces the availability of the product by making it too expensive, and it is limited. It has forced the CEA to, or the CEA has chosen to reduce the coverage available as a way to kind of maintain affordability, but still seeming to need to raise premiums or share as you know, in any event. And so we just think that we have less available coverage with this high return period. So it means that a fewer number of people will be fully protected and more people will be totally unprotected. We believe that that graph that you provided, those 1 in 350 and 1 in 250, is really helpful. I think it really demonstrates that a 1 in 250 year event is a very reasonable and still conservative approach to this. I think that if you go to the 250 slide, the next slide, you see that even with a 1 in 100 year event, you're still left with $7.5 billion of claims paying capacity. I think that that's more than conservative. So I think that the fact that we could get so much benefit in terms of availability and affordability and quality of coverage by reducing to a lower claims paying capacity, we would love to see this graph of the 200-year claim paying capacity and see where you get with that, because our suspicion is that even in that event, you would still be a reasonable sustainability opportunity without having to, deny people full claim payments in most scenarios. And just finally on this point, we're of the view that while we would never want anybody to not get the 100% claim payment, while we don't want people to end up with less than 100% of their claim being paid, we feel there is social value as well as consumer value to having access to a coverage that in almost every situation will give 100% payment to more people than one that in still almost more, but not, of course, every scenario, give 100% payment to all claims, but to fewer people. So again, we just think that the value of more people having access to this coverage eclipses the value of having fewer people have a higher likelihood of getting full payment. And in all cases, we're still dealing with a very, very high likelihood that everybody will get full payment. So that's sort of my overarching thought, that really urges the CEA to drop its claims paying capacity return period in order to provide both more affordability, more availability, and higher quality of coverage.
Doug, thanks for those comments. Really, really appreciative. And I apologize, I didn't follow up with Sarah on this one. And so I'll also follow up with you first, Doug. So on this one here, the remaining after that 100-year event, when we have a 250-year claims paying capacity tower, is a claims paying capacity of 76 years.
Right.
And $7.54 billion. So the last question on the next slide of what is that return period, or how should we be thinking or talking to our board about, after some sort of event, where does it start to have concern that either agents or participating insurers or consumer groups, where should we be, and what financial strength should we have to issue a policy the next day?
Yeah, if I might, because I just want to respond a little bit. I mean, and I guess respectfully, Doug and I may disagree on this, but I mean, the idea that you're going to just continue to erode the claims paying capacity in order to keep rates low, arguing for continued expanded coverages, and then lowering the claims paying capacity, knowing that could result in a pro rata, so people aren't getting fully paid out on the insurance they bought, but then saying the idea of having a second event tower to ensure the continuation of the market to ensure that the people who have paid in continue to have insurance. That seems like a pretty specious trade-off there. And I don't know how long the Earthquake Authority can continue going down the road of lowering its claims paying capacity, supporting expansive benefits, and just with the ideal that we're just going to keep it cheap and grow and keep pushing aside long-term financial sustainability. And it just doesn't seem like a sustainable or smart path to us. So, again, we may disagree on that point, but that's certainly, I think we don't want to be back in a position like we were in 1994.
Tom, just very briefly, I appreciate, and turn to Karen. I just want to make the point clear. I am not saying that you just reduce it to some minimal return period. There is no residual market in the country, and I understand CEA is not exactly a residual market, but there is no residual market in the country that has more than a 1 in 100-year event period. We're talking about a debate between 1 in 350 and 1 in 250. I know other programs have other kind of post-event funding mechanisms and such, but I don't want to be present my perspective here as doing something that is somehow radical. To be at a 1 in 250 or 1 in 200 year, a 1 in 200 year event would be kind of a dramatically more than any other market uses in the country. So for catastrophic exposures. So I just wanted to be clear on that.
I appreciate that. And I think at some point, maybe that will be a discussion on August 1st or some other time to really understand. I appreciate you making the point that we aren't a residual market. And I think the big variance between us and those residual markets is that post-event ability, which takes like Citizens from the 1 in 100-year event to, not near unlimited, but tens and multiples of tens of billions of dollars of post-event bonding capability, and which pushes them up to, potentially even our level of CPC by assessing all consumers throughout the state post-event, which is tough for us, given, as you mentioned in a previous meeting, only 13% of the Californians buy this, and should the whole state be assessed post-event. So it's a difficult one, and something I look forward to continue to discuss. Karen?
Yeah, I think that the 1 in whatever return event, it's unique to the earthquake peril, and that you can't necessarily compare it directly to, I think, hurricane, just because the earthquake risk is a very distinctly different one with very, very significant magnitude impacts that can occur. So I wouldn't want to see it drop significantly more. On the discussion of the regions, I strongly feel that the sustainability needs to be that the CEA would continue. You may have one very heavily populated region, Los Angeles, for example, that's completely devastated, but we have extremely heavily populated regions in multiple places throughout the state. It's a very large state geographically. You can't compare it to states in the Northeast where it's all concentrated in very small, footprints. We have a lot of population that would need to continue to be served. So we want to see that continue. I don't have a specific preference on one tower versus multiple towers. I'll defer to others that are more knowledgeable on that structuring, but we would certainly want to see that the CEA would continue to survive and continue to serve the policyholders in California. The ways that you can address the overall exposure, obviously we've had the conversation on mitigation to reduce that loss. There's the inclusion of limits on how much we're willing to provide. But as far as claims paying capacity, I still continue to kind of raise that conversation on also loss adjustment expense. And I think this is where parametric concept can sometimes provide some benefit, and that it may reduce your overall expense side of the equation and the cost and the administration of servicing that high volume of claims that would come in a very, very significant magnitude event. So I don't want that to get disregarded as another channel that you can maybe really continue to pursue to balance that overall cost need. So I'll leave it there given time, but.
Thank you, Karen. I appreciate the comments, and yeah, we're happy to continue on. This has been fantastic dialogue, so we really appreciate it. Dennis?
Sorry, I had to move hospital locations. With regard to the comments by Karen and Sarah, I I generally agree with those, so I won't comment further. I just wanted to point out that Doug's comment that no residual market has more than a 1 in 100 claims paying capacity is factually wrong. His statement about 1 in 200 is probably close to accurate. I don't have all of the coverage charts in front of me, but if you look at the South Carolina Wind and Hail Association, which is essentially a traditional fair market, it has significant reinsurance well above 1 in 100, as well as its own claims paying capacity. So there are other, and the whole concept is, as we all know, Steve Geller from Florida used to, when he was the senator, used to make the comment that a 1 in 100 means there's no chance of it happening in our lifetime, which is completely fallacious, great political theater, but it's fallacious. The point is, these are probabilities that can happen each and every year. And that's what needs to be borne in mind. A 1 in 100 is 1% risk. 1 in 250 is a 0.5% risk, I think. And a 1 in 500 is a 0.25% risk. So there is some risk, and we always have to remember, as the modelers use this, we're using the bottom end of the scale. So the 1 in 100 number that comes out is going to be this size X or larger. So I'm not saying you're using the bottom of the scale, but when we talk about these numbers, we're saying that number that comes out is usually the amount or larger amount that is utilized. I can't comment for the number you're using, but that's all I wanted to say. I just, we need to. I think Karen's comment that what we need is a CEA that can perform and be eligible and capable of issuing stocks and I mean insurance policies the day after a large event. And we also need to recognize that as the CEA weakens, the decisions that we're making today to hold rates potentially lower than they might otherwise be will be impactful upon that time period, because those rates may have to go higher because of capital insufficiency. And that's the only point I want to make. So thanks.
Thanks for your comments, Dennis. Robert? And you're on mute, sir.
All right,
Thanks.
really briefly, and then I do have to take off, and I fear others do as well. I think Doug's broader point is still very salient, because the context is 1 in 350 to 1 in 250. That's the slide that's being shown right now. And so I think his broader point is still very well made and taken. And the other thing that sticks with me is the point that Joel made about, while we can't predict with exact certainty what's going to happen with CDI in the homeowner market, we can certainly see the proposals that are on the table and beyond. And I won't delve into that right at this moment. You're probably going to impact your take-up rate in a negative way. I think Joel's point is accurate. We don't know it to be true, but it would shock me if it wasn't true, depending on what happens. Therefore, I think the point that Doug made is even more important, that for the CEA, for Tom and the leadership of the CEA and the members, the board to decide on going from 350 to 250, I think is very relevant when we're talking about affordability and we're talking about coverage, and that it's a terribly important conversation. And I look forward to the August session if I can make it, but appreciate everybody chiming in, even those I disagree with, especially those I disagree with, I suppose. I appreciate them chiming in, and look forward to the subsequent conversation, and thank the CEA for convening this.
Thanks, Robert.
Thanks for your comments, Robert. Joel.
Yeah, I'll be very brief as well. I just also want to add that United Policyholders position supports what Doug said as well. I mean, obviously there's a balance here of which way to go, and we favor moving to make this a balance a bit more toward affordability and availability than where we are today. Thank you.
Thank you, Joel. Any other questions before we pitch it over to Tom to do a wrap up and tease on August 1st meeting?
Oh, I would just ask Tom, per the point about Dennis's point, I'm certainly happy to be corrected. And if in fact South Carolina can't find South Carolina's claims paying capacity, it was the CEA staff who told me that no other markets that they found, as with me, had more than 1 in 100. So I think it'd be interesting to have a good comparison of that, because I think it informs the discussion usefully. I stand by the point that the vast majority, is at least all that I've reviewed, have that. But I think that it just in terms of helping the conversation go along, it's as per Dennis's point, I think it's much better to be operating with really accurate. And I apologize if I was overstating what I had understood to be true, but I do believe that in most cases, if not all, the 1 in 100 year is the claims paying capacity standard. So I'd be appreciative if you could have something like that to help clarify, so we can sort of operate from that as just a model comparison at the next meeting.
Got it. Sounds good, Doug. Thank you. And I'll roll it over to Tom.
Yeah, and given the time, I'll just make this really brief. At the very end of the deck, we kind of laid out what our goals are in another session in August, and this, don't expect this to be the last. We're going to penalize you for the vigor of your participation by creating additional opportunities for you to continue to provide this kind of feedback, because this is exactly what the board asked us to create as an opportunity for all of you to share your views, whether you agree or disagree. And I really do want to comment on how much I appreciate the fact that this has been a forum in which all of you have shared views, even though they differ with each other, but we've done it in a context of, or in a spirit of mutual respect, because these are hard issues that we in the state need to grapple with. So I really want to thank you and appreciate you for both the substance of the contributions and the spirit in which you're joining in to help us and help our board. On the August 1st meeting, our initial thought was we've broken this up into segments, and we want to kind of bring back together a more holistic discussion about the different objectives and that we need to balance between and among as we talk to the board about a long-term strategic plan, and your views on all of these related and connected items is what we want to do in the next session. But we can also spend a little bit more time at the front end and maybe sequence it so that we can click in on sustainability a lot. Because I had, as we talked, I had a lot of sort of follow-up questions and thoughts. So we may, as we build for August 1st, we'll do the same thing, and we'll send around a slide deck with these kinds of policy questions and prompts to help people think about and prepare for that more holistic discussion. If there's any other additional topics that you think we should seek feedback on, we're all wide open to hearing that and incorporating additional thoughts into that. So feel free to ping us separately and make some suggestions about what you think would make August 1st and subsequent sessions more productive. And with that, unless there's any final thoughts, questions, suggestions, we can let you go. And thanks again for letting us occupy an entire 2 hours of your day. We found it incredibly useful, and I guarantee our board will really appreciate the commitments that you're making to us and the investments you're making in our success over the long term. So with that, absent any final comments, Thank you very much. And we look forward to seeing you on August 1st, if not before. We're around, we're available, so reach out to any of us if you want to have separate individual conversations with us. Thanks again.
Thanks, everybody.
Thank you.
Joining.
Thank you
Take
all.
care.
Bye, Dennis. Bye, Doug.